Program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity, prepare for your retirement, safeguard your savings, and nurture your investments. This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Welcome to the Max Out Savings Show. I'm Ted Gioka, and we're talking savings, investments, in your retirement. The show is live today. We were preempted on the Saturday show by Baylor, and so we're here today talking savings, investments, in your retirement. Our motto and our philosophy is to save aggressively and invest conservatively. It's save aggressively and invest conservatively. That's the key to building up wealth over the long term. And you want to kind of start with your different qualified plans so you can get set up. You want to put away 10%. Qualified plan is a 401k, 403b, 450, those type of things. You want to put away 10% plus the company match. And you really, if you get it up to that level, you're going to be in good shape. I mean, that's the real key. And if we say the company, the research is about 13%, and then you can save after that, you can spend after that, but you will be able to build up a big retirement. And you conservatively invest the money, and that's getting tougher and tougher every day. In the world today, the markets are very volatile. So you have to keep track on it. Typically, most people do a 60-40, 60% stock, 40% a bond layout to kind of diversify some of the risk. A lot of people are 100% stocks, which works, but the danger is if you get into a situation like, if you look at some of the numbers over the long term, markets go up and they go down. And we've had a pretty good run in markets. I mean, if you look at it, this year the market went down. The number I have is 23%. I remember it going at about 18.5%. Sell off, and then it recovered in 1.5 months. Which is, it's like, hey, so you want to be in. In 2022, that was a vicious market. It went down 27% at one time, but you recovered it in 18 months. So you want to be fully invested all the time, or so the saying goes. COVID, it went down 34%, but you recovered it in 6 months. So it's like, look, why would you ever be out of the market? And the problem with that is, if you're a retiree, if you look at some of the numbers, the panic of 1907 was 48% decline. It took 10 years to get back. The Great Depression, the market went down 89%. It took 25 years for the market to come back. If you look at the inflationary oil crisis in 72, there's a 45% drop in the market. It took 9 years for it to come back. And those type of numbers are devastating if you're have retirement program, if you're retired. And the research, interestingly enough, some of the research out there has actually been saying that you're better off in retirement managing your money more conservatively initially for the first maybe 5 or 10 years, and later on it doesn't make quite as much difference, because the real damage to a big decline, if you get big declines throughout your retirement, it doesn't hurt as much as it is as soon as you get into it, because your retirement, you're typically going to be retired for about 25 years. This is really very counterintuitive, because people will look, when you first retire, you've got 25 years, so you can have higher levels of stock and just kind of ride things through. Well, understand, you're not getting any new income coming in for most people. They're taking money out of their plan. That's what's fundamentally different from when you're working. And so you do want to understand that, and so if there's a big decline, it can really hurt you if your savings get. If you've got, the easiest number is just to work with $1 million. If you got $1 million and in your retirement plan, and the market drops, let's say it drops 30%, you all of a sudden have $700,000. If it bounces back in a month and a half like it did earlier this year, well, hey, that's not a problem, or even 6 months. But if it stays down there for 2 or 3 years, you're pulling money out, and you're expecting to pull money out at a higher rate at the $1 million level. That's incredibly damaging. So it's important to understand retirement dynamics, how to manage money in this type of world. Some of the other numbers, and it took in 1987, it took 2 years for the market to come back. But it was in the .com. It took about 15 years for that to come back. So 15 years, 5.5 years with the great I'm not sure about the .com, but for the great, financial crisis in 2008, that was 52%. I've got, actually, that was 57. I remember that. It was 5.5 years then. And one of the things, so if you notice, further back in history, the declines took longer to come back, and it's really accelerated with COVID. It only took 6 months, 18 months from that big sell-off in 22, and only 1.5 months for the sell-off this year. And that's because the Fed rushes in and floods the system with money every time. The problem the Federal Reserve is running into now is everybody's onto that game. It's like, wait a minute, you're going to depreciate the money every single time, and so people really aren't making more money. You're just printing more money. And so they're going to be under a lot more pressure not to print the money, because the dollar will collapse and we'll get a hyperinflation. And so I think it's going to be harder for the Federal Reserve to flood the system with money in the next decline. Sure, they can cut rates, but it's going to be harder to be giving away money to everyone under the sun, because keep in mind, we're borrowing at a rate of about $2 trillion a year additional money. That's our deficits are $2 trillion. Our debt right now is $37 trillion. And people are like, look, we're not funding this debt anymore. And so this is, I think it's going to be more difficult next time. We're going to be talking some more about that on the show here later today. But so I think you want to continue to stretch out that widen out that diversification with your retirement into different asset classes. It's not just stocks. It's not just the S&P 500 and 40% in medium to long term bonds. But it's short-term bonds, it's overseas bonds, it's overseas stocks, it's small-cap stocks, it's commodities, it's precious metals. All of those things, as you further diversify out real estate, you further can manage your risk if you get different types of assets that do things. If you look at the precious metals stocks, which we've been talking about for years, and I think our first max out savings report, we predicted, it was 2001. Actually came out, we found a report the other day that referenced it, and I think 2003 the report, but we said we said there was going to be a huge bull market in gold. Only place we were wrong on, we said it was going to be a 20-year bull market. It looks like it's going to be a 25-year bull market in gold. During that time frame, gold has pretty much outperformed the S&P 500, and so what you're doing is you want to spread out that risk. You want to protect yourself from a world where you have $37 trillion worth of debt. You've got basically the Mag 7 stocks are worth $20.4 trillion. But I'm not even sure China has a higher GDP than that. I mean, the Mag 7 are just become so dominant. It's been remarkable. And if you look at the S&P 500 right now, it's about 50%. It's 53% in technology stocks of one form or another. Now, keep in mind, according to Standard & Poor's, which runs the S&P 500, the company like Amazon is in retail, or if you look at Google is actually an advertising company. This is how they get away with this massive concentration in tech, by claiming they're in other businesses. But everybody knows these companies are all tech companies, and so So we have this massive overconcentration, and so I think going forward, the key to retirement is really going to be to protect yourself and protect your wealth for what's coming. Again, they talk about the $37 trillion worth of debt. We talk about the $2 trillion a year. We talk about deficits for 5-year running of 6% of GDP. I saw there was a warning from one of the agencies that Saudi Arabia was in trouble because their the oil their oil sales aren't covering their spending, and they're going to have a deficit of 3.5 or 4%. We've been running 6% plus deficits for 5 years. I think one of them was a little under. A couple of them were well over 6%, and so it's average, which is enormous. And so this is why the dollar has been falling. You know what the second worst performing asset class this year was the United States dollar, down 9.8%. And this is the reason why people are like, wait a minute, you keep printing money, you're sanctioning everybody under the sun, you're confiscating their treasury bonds, and people are like, look, and you're running $2 trillion deficits, you've got $37 trillion in debt. I mean, it's like this is you guys clearly aren't the reserve asset of the world at this rate, and so. So what we're seeing is now I believe. Look, I believe fundamentally Donald Trump is moving heaven and earth to try to fix that, and he has a plan in place, and it's important to understand that. And a couple things. What they're going to do is he's putting tariffs in place. This is going to do two things. It's going to generate income. They think they can generate over $300 billion a year in income from the tariffs, $350 billion in income from the tariffs. They're going to try to grow the economy by reducing regulation, cutting taxes, and encouraging companies to move their factories back here to get better deals on tariffs. So the economy is going to grow as well. And then in addition, he's also pushing the Federal Reserve, and this is lost on a lot of people, the Federal Reserve to cut interest rates. Trump's going wild about interest rates. Look, he wants them cut. The market's at record highs. The valuations are off the charts. The economy isn't that bad. The reason he's doing this is because he realizes the Fed, we're borrowing, a good chunk of our borrowing is short term. If we can cut rates 1.5%, we can save hundreds of billions of dollars there. We could save possibly another $250 billion or more. That gets up to, between those two things, that's $600 billion in savings to try to reduce this deficit. So he has a plan, and actually, one of the more remarkable things about the Fed and Trump is every single time you listen to the arguments, it's always about tariffs. It's like, well, is tariffs going to be inflationary or not? Trump is trying to force them down, which is going to cause what the mainstream media does not want to talk about at all is this $37 trillion deficit. They don't want to talk about a $2 trillion debt. Why is that deficit every year? Well, the reason is very simple, is because if you really have to take a hard look at this, and the fourth way to cutting is cutting spending through the Doge Commission. Another thing is candidly, we've got to cut a lot of spending. We've got to cut some entitlements. I noticed Trump's trying to reduce the disability, make it tougher for people to get disability for Social Security, because all these people on disability are draining out Social Security. There's actually it's called the disability. I'm on the disability. It's not like I fell off the scaffolding and broke my back and I'm in a wheelchair. I'm on disability. These people are just scamming. Many people are scamming the system, claiming that they can't work to get on free money. Well, all of these things. So the dirty truth about everything you're hearing out there with Chairman Powell and Donald Trump is the fact that nobody wants to talk about this massive deficits, this massive debt, this out of control spending. Because if you talk about the massive debt, you've got to cut spending. And the Democrats or the Republicans clearly, if you look at the senators and the Republican side and the Democrats, none of them want to cut any spending. None of them want to cut any entitlements. And so understand that this is a big issue. It's not going away, but Trump has a plan that hopefully he's going to get out of, but we've got to further cut spending, and this is one of the reasons we're doing this government shutdown. Anyway, we'll be right back to talk some more about this. How is this going to affect markets going forward right here on the Max Out Savings Show?
The Max Out Savings Show with Ted Gioka is taking your calls now at 713-339-1070. Ted Gioka will return after these messages.
This is Ted Gioka, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com.
I'm Sam Malone, president of 512 New Media. We're Houston's leading marketing and content creation firm for many reasons. Our assets are exceptional, from video production to web design, strategy, and the ability to say no. Saying no is integral in launching a successful, profitable campaign. For example, take a look at Memorial Day. It's a federal holiday set aside to honor and mourn those in our U.S. military who died while serving our country. I'll say it again, for those who died while serving our country. So how does having a sale work in unison with the reason for the day off? Look, we know people will be at the beach and barbecuing and having parties. We would probably say no to launching a Memorial Day sale. So is there another way to commemorate the day while marketing your brand? Absolutely. And from our experience, the same holds true with Easter Day sales and MLK Day sales and Christmas Day sales. That's why we're different. No cookie cutter, follow the crowd, template marketing. Let's talk. We're 512 New Media. 512 New Media. With better marketing comes better value, creating better results.
Once again, here's your host for the Max Out Savings Show, Ted Gioka.
In the 1970s, the big song was the Bee Gees' Staying Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
We return now to the Max Out Savings Show. Here's Ted Gioka.
Welcome back to the Max Out Savings Show. If you got any question or comment, we're live here today on Sunday, 713-339-1070. We're not always live, but because the live show was on Sundays at 10 a.m. or Saturdays at 10 a.m. But 713-339-1070. So one of the more interesting things out there is, if you look at the divergence of what's called the spread between governments and corporates, and that spread has gotten remarkably tight over time, and which is just the spread between what a corporate bond is yielding compared to a government bond, and typically it's always over a certain amount, but one of the things that's happening is that there's much more demand for corporate assets, and this is a big deal. I think that people don't really understand what's happening. We like to trade you into things that are happening, try to get you a little ahead of things. The current yield offered by investment grades has shrunk to a three-decade low. Actually, there's a story in the Journal today about it. But what the world wants are corporate assets, not government assets. If you look at the world right now, what's going up? Stocks are going up, precious metals are going up, Bitcoin went up, Treasury bonds yields aren't declining. They're actually still staying up pretty high, and because and the yields on corporate debt are falling faster in relationship to government debt because the people want big investors. They want corporate assets, not government assets. Now, this is a real important thing. For the last 100 and something years, go back to 1900, probably before that, but to 1900 easily. Everyone in the world wants government paper. They want because that's the safest. Corporations can go bankrupt. Corporations stocks go down, and the corporations can issue more stock. Corporations can, they can get in trouble. But what's happened is, around the world, governments have gotten so prolific. Printing money that the world is rapidly, investors are losing trust. Around the world, governments are running up massive deficits across the board. Around the world, governments are printing money. The dollar's down 9.8%, but many other countries are falling as well. Almost countries across the world, gold is rising faster, and stocks are rising faster than the currencies. And this is the whole world is massively in debt. I mean, look at France is in really severe trouble. Their entitlements make us look like China in comparison. They're so bad. And again, the minute they try to cut the entitlements, there's riots all over the place, and the prime minister has to resign. And they're in big. Other countries around the world are all in trouble, and so it's leading to this massive shift. At the same time, governments need more and more money to fund their payments, their entitlement programs they put in place, and so we've got this clash coming. This is what we've been buying. We're very, very conservative. It have been for a while on our corporate debt. When we see opportunity, we move into the markets and stuff. But we just haven't been paid a lot to do it. We saw the inflation coming back in 22. We moved to short-term bonds and in lots of treasuries. We still own a lot of treasuries, but we've been buying a lot of corporate bonds as well because the corporate bonds were getting paid more. But in the event of a crisis, if something happens, or a massive devaluation, we feel we're safer in some corporate bonds. Now we look at a certain type of corporate bonds. We want higher grade corporate bonds. We don't really we analyze the bond. We try to run when we're doing it for bonds and that type of thing. We're trying to analyze it running through a very, very, very severe recession to ensure we're going to get paid on our bonds. And if we don't get paid full amount, we're getting paid more than everybody else in the markets. We want to be, proverbially ahead of the bear. How do you avoid getting eaten by a bear, run faster than the other guy? But we want companies that will ride through extremely severe recessions, and that kind of counts out a lot of financials and other stuff. This has kept us tremendously out of trouble in 2008 and other times. And because the financial balance sheet in a financial company can destabilize very quickly on something like a railroad or something, the railroad's not going anywhere, and they're going to need the railroad next week, and it tends to be more stable. But this is one of the reasons why we've been doing this for our clients is with these corporate bonds. But in the rest of the world is seeing it. This is one of the reasons why gold is going up. It's this shift. The dollar was the global dominant asset class. In treasuries were the dominant asset class in the world. Actually, outside, I think Chinese real estate was actually was a higher valuation, but we saw what happened to that the last couple of years. But what's happening is with all the government money printing, with all the entitlements, with the sanctions have probably done more damage than anything. If there's one diplomatic thing that does not work, that has the most remarkable record of failure of any policy I've ever seen, it's government sanctions. I've said this on the show, if I was a dictator from some third world country, the first thing I would want to be is sanctioned by the Americans. That means I'll be in power forever. I want to be a pariah to the Americans because, look, they could never get rid of Fidel Castro. I mean, how many of these people have they been saying? Same with Iran. I mean, the same people are there that when they, from what, 30, 40 years ago? It's like it's the same thing with Cuba. They're there for 50 years. Fidel Castro is the longest living dictator. While we're sanctioning these sanctions, do not. When we sanction the Russians, we've been trying to kick them off the SWIFT system. We confiscated their treasuries, and now everybody on planet Earth is trying to get out of the treasury market. If you're a central bank, or at least reduce your exposure, because you don't want to be sanctioned, or you don't want yours confiscated either if a war breaks out. And so you're seeing this massive shift. At the same time, many governments around the world are having financial difficulties in this shift into corporate assets. And so by building up portfolios and managing through that, I think you're going to have a much better quality long-term return in your portfolio. But this is a global thing. I mean, the state, and again, the world wants corporate assets, not government assets in the investment world. That's where they're starting to favor. If you look at the spreads, they're very, very narrow between what a AAA or a AA now corporate U.S. government bond is yielding and a AA corporate bond is yielding. That's just because they're spreading their risk. Because what happens if the U.S. defaults? Keep in mind the government shut down. In theory, it could default. We're not looking for that, but if it defaults, they can't have all their classes, and that was once unthinkable. But now nobody is sure. The Chinese aren't going to support us. If you look at most past crises, 2008, even 87, 2008. If you look at the .com bubble, typically countries kind of pull together because no one wants the whole thing to fall apart. And so the Chinese will help us out. The Europeans will help us out, or we'll help the Europeans out. The Chinese will they'll start growing their money supply to get the Chinese economy going a little bit. And we'll put in we used to put in $100 billion spending, supplemental spending program. Now that's like chump change, but to get the economy. Now you got the Chinese, they're not going to help us out. The Russians aren't going to help us out. Many people around the world aren't. The Europeans, we're back and forth with the Europeans. You've got all these cross currents, and you have a very unstable world. And so in that world, you want to continue to spread out your assets across these multiple asset classes. Well, look, one of the best returns have been in foreign stocks this year. European stocks, Asian stocks. Again, it's kind of a global move across the board. So what did we do in this type of? The market is up. The market's up, I think, 13-14%. There seems to be somewhat of a melt up of advisors and asset managers all chasing the market now, so they're running around, pouring money into the stock market. If you look at the ETF flow in the last, I was just looking at some of that in the last 3 or 4 weeks, has been just gigantic into the market as advisors are trying to catch up, managers are trying to catch up to the market. We're cautious in here. I think you have to be somewhat cautious. We've been selling more stuff than we've been buying. We actually put a hedge on, and so it just because our gains have got they're substantial, and we just felt we need to do something to try to mitigate a little bit if anything goes down. But there seems to be a big push. The problem is all this money's coming in at the top, and at the same time, the economy appears to be slowing. Now, everywhere we talk to people, business seems to be slowing down. Well, let me rephrase that. Everywhere except AI, business appears to be slowing down. There's numerous layoffs going in the oil and gas industry. If you look at
accessibility.
Sorry about that. I never figured out how to get that off of my Apple. But if you look at something like the West Texas crude, that's been falling. It's actually oil is down year to date about 15%. And that's not indicative of a strong economy. If you look at restaurant sales, if you look at other types of sales, really, you look at liquor sales, they're down, and those are kind of precursors. Now, there's a couple things happening. The economy just isn't that good outside of AI. But in addition, we're trying now to get rid of we've cut back illegal aliens coming in. We've had the biggest surge one of the largest surges in U.S. history of illegal aliens, numerically the largest ever, where they had somewhere between 5 and 10 million illegal aliens pour into the United States under Biden. Anybody that ever wanted to come into the United States could come in, and so that put huge pressure on housing. It put pressure on expenses. It raised the cost. All these illegal aliens, many of them are getting free telephone, free. I mean, now that I think about it, I pay a lot of money for my phone, but they got a free phone when they came in there. Many of them got free housing. It's just one thing after another, running up our costs. Inflation went up. So what's happening is now the Trump administration, they're expanding ICE. They're patrolling the cities. They're capturing illegal aliens and sending them back to their country, and they're here illegally, and it's pricing. Young people can't afford houses and stuff in home apartments because the costs are going up so much because there's such a demand from all the illegal aliens coming. But this is the important, and this is you don't hear this much out there, but what we believe is happening is we believe the economy is slowing to some extent because a lot of these illegal aliens, because keep in mind, there's illegal aliens that have been here for 5, 10, 15, 20 years. Many of these people are incredibly high quality citizens, not citizens, but workers in the United States and solid citizens, not official citizens, but good citizen type of people. But they're all nervous too because they're like, oh my God, what if I go out, out to the restaurant and I'm coming back and I get pulled over and I get caught for a speeding ticket and I get deported? What am I going to do? And so they go to work, they come home, they go to the grocery store, and that's it. They're cutting back their traveling. Travel is way down across the country. Travel's down in Las Vegas. And so we think they're really slowing down the economy because people are scared. They're not going to go buy if they've been here 5 or 10, 20 years, maybe they're thinking of buying a car or a house. They're not going to do that now because they're not sure. And so this is slowing down things out there. And so we think the economy is slowing down. And so this is why I think you have to be a little careful. And you got a sky-high stock market. You got incredible. I mean, any way you look at the valuation across the board, the valuations are extreme. Look at market cap to GDP, price to earnings, Shiller ratio. I was listening the other day. The Shiller ratio, which is kind of an averaged PE, is about 20. I think it's like 22. The high at the peak in 99, it was at 24, but the taxes were higher. So if you adjust for the tax rate, it actually goes to 20. So any way you look at it, we got a very expensive market here. And so this puts a lot of risk, more risk into this market than I think people understand. And this is something that we want to watch because I think you got a tough row into the year end now, with the economy, and then if they can get some of the factories going, it should start picking up next year, and that's something we're going to watch. Now the market could melt up into year end and then completely fall apart at the beginning. That it's hard to predict exact, but as far as the economy goes, that's what we're looking for, and that's why we're much more defensive for other people. We're not just throwing caution to the wind as many people. So let's take a quick break. We'll be right back right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioka will return shortly. To speak with Ted Gioka now, call 713-339-1070. Back in a moment with the Max Out Savings Show.
I'm Sam Malone, president of 512 New Media, where We're Houston's leading marketing and content creation firm for many reasons. Our assets are exceptional, from video production to web design, strategy, and the ability to say no. Saying no is integral in launching a successful, profitable campaign. For example, take a look at Memorial Day. It's a federal holiday set aside to honor and mourn those in our U.S. military who died while serving our country. I'll say it again, for those who died while serving our country. So how does having a sale work in unison with the reason for the day off? Look, we know people will be at the beach and barbecuing and having parties. We would probably say no to launching a Memorial Day sale. So is there another way to commemorate the day while marketing your brand? Absolutely. And from our experience, the same holds true with Easter Day sales and MLK Day sales and Christmas Day sales. That's why we're different. No cookie cutter, follow the crowd, template marketing. Let's talk. We're 512 New Media. 512 New Media. With better marketing comes better value, creating better results.
This is Ted Gioka, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com.
And now, more of the Max Out Savings Show with Ted Gioka.
Welcome back to the Max Out Savings Show. We're just talking about the markets, very high markets. Things are going real well. You know, is it a time for caution, or do you go in all the way? People are pouring money into the market right now, and that's, you know. So the question is, I think $152 billion has gone in about the last 4 or 5 weeks into the global ETFs, and so I still think you want to be in the market, but we're going to be a little cautious in here. We talk about this thing with the illegal aliens. We believe are slowing the country. There's been a couple of things. There's been 3 companies. Tricolor, which was a low, not really a low income, but a low credit score type of lender on the auto business. It went out of business, over $1 billion in assets. CarMax had real problems as well, and the stock plunged 20% in one day. CarMax is a big used car retailer, other things. And then First Brands, another lender, has filed for bankruptcy. And this is going to really tighten up the auto out there. And it's not just that these people, but anyone else lending into the subprime auto market area is anyone that goes into that is, if they're lending elsewhere at the other companies, they're going to go, well, whoa, look what just happened to Tricolor and First Brands. We need to be more cautious here. So I do think this is going to continue to slow down the economy. Now, the one good number is the fact that we have the AI sector is enormous. Hundreds of billions of dollars are being spent on that. I mean, we talk to companies out there, and we're slow. It's slow, but you know, we're selling, and we just got a big order from an AI company, or we're doing this with AI for servers. This is enormous amounts of money. The amounts of numbers are so, people can't even understand how big these numbers are. I've seen some numbers of $2.4 trillion, but out to 2030. It's really starting to put pressure on the big tech stocks because their spending is going up huge. If you look at the tech companies, the numbers came in at about, typically they had about 34% in 2020 of what they were spending of their cash flow. Now it's over 50%, and so what we're seeing, this is putting huge pressure across the board, and that doesn't even include what they're doing. They're making deals with other companies. It's at 55% is what it's going to be for 20. It's going to be more for 26. And a lot of the companies are making deals to, if you build the AI data center, we'll take all, we'll give you a contract, so we'll take all the usage from it, and so it's not on their balance sheet, but it's still a liability. And the question is, of all this, probably $3 trillion worth of spending, and keep in mind, it's not just there, but it's also we're upgrading our electricity network. We're putting in power plants. We're putting in nuclear power plants, wind plants, all this massive amounts of spending going into this. Will this stuff be profitable? And I think it was Oracle. They had a deal for $300 billion worth of sales over the next 5 years. It was going to require as much electricity as two and a half Hoover dams. And the Hoover Dam was the crowning achievement and the biggest electricity producer during the Depression in the United States at the time. And it just shows you what we're dealing with. And so when it comes to AI, I think the trick is going to be, if you look at any industry, there's always one big winner. It's Microsoft for operating systems. You can maybe say Apple does some there, but Apple is the winner there. If you look at social media, Facebook controls that with Facebook, Instagram. If you look at advertising in the internet and browsers, that was Google. And so the question is, they're pouring all these money into all XAI, into Microsoft, ChatGPT, OpenAI, Oracle, NVIDIA, all these guys, everybody, Apple's getting into it, Meta's getting into it. Well, the problem is that's gigantic amounts of money pouring, unlike anything we've ever seen, pouring into it. And the question is, who are the winners going to be? And I think so they're going to start parsing that. My philosophy there is we're just going to sit back and wait and see who really looks like a winner on this thing, and we're going to wait till the crisis hits, and then we'll be looking to pick them up cheap. We went through this with the .com bubble, and it takes time, and huge winners came out of that. But huge winner. I mean, I just saw some numbers of actually one of our clients. We picked up some Microsoft. I want to say it was the 08 or something, or it was either 2000 or 08. I just couldn't believe it. It was just astronomical returns on it. But in the interim, the stock had plunged and people had lost money all over the place. And so I think that's when it comes to the tech. I think you have to be cautious. The S&P 500, as we said, is 56%. 55%, whatever the number is, in that of technology related all over the place. And the problem is, we just laid out the case that look, there's going to be some phenomenal investments. There's going to be some money that basically they're going to lose huge amounts of money on, and we don't know who is. We don't know who the winner is going to be. Who's going to be the Microsoft? We don't know who's going to be the WorldCom, and so the problem is, the majority of the S&P 500 is piled into this sector in one shape, form, or fashion after another, not really in the AI, but technology in general, and that presents risk. And so this is one of the things I think we're going to see going forward is how does this play out? I think we're near some type of top here, and I just think in the world today where we're dealing with these massive build outs, we're dealing with, you really have a couple things out there, right? We have a lot of negatives in the world. We have the United States government with $37 trillion in debt. We have debt spinning out of control. We have a war in the Middle East, which hopefully they'll sign a deal here, but I'm not even sure it's over yet. We have the war in Ukraine with Russia that I'm very surprised. I think we've been reasonably good talking about this and keeping everyone up to date with it. And since the beginning of the war, where we talked about the inflation it was going to generate, because we spoke about the assets that were produced in Russia and the Ukraine, everything from fertilizer to oats to oil and gas, and how it was going to pressure inflation. We were right. But I'm surprised that we're not seeing that Putin's not come to the table, and you wonder, does this thing spiral out of control? If NATO somehow comes in, if Russia just starts overwhelming, Ukraine's offense is at some time NATO likely is going to have to come in on the western flank and to stabilize the situation. That's not going to be good for the markets. What's going to happen with China? What's going to happen with Iran? What's going to happen with these huge deficits we have to fund? And all of these things are out there now. Is this credit situation going to sit there with Tricolor and First Brands and is that going to spiral into something? So all of these things are out there. So now the positives, is, hey, this AI is going to get good. We're going to be building it out. Trump, I use the number of $500 billion worth of factories coming back. Now, Trump's numbers are like $2 trillion. I'm saying, hey, 500. Now, these factories take a while, but Trump's been talking about this for a while. They've had probably 6 months to start getting the factories the permits. Most cities and states are falling all over themselves to give people tax breaks, regulation discounts, and to get the factories in place. So I think these factories are going to come up a little quicker than people think, which should be good for 26. And President Trump is going to try to get the economy going for 20. Remember, he doesn't care what people think right now, but he cares an awful lot what they think this time 1 year from now with the midterm elections are going to be in basically 30 days. That's the key. This is the key time. So he does not care what the economy is doing, how bad it is right now, but he's very concerned 12 months. So going forward, I think there's going to be real opportunities next year. And so this is something you want to watch, but I think you got the trough right now in earnings. I think they're going to probably do something to try to lay off the illegal aliens or, maybe give people work permits if they've been here, something to get the economy going in 26. You're going to see that. Hopefully we've got some peace deals elsewhere, and that could help things out. The problem is right now you just have such a frothy runaway market with going into what appears to be a slowing economy. So something to think about. And again, what we really talk about with retirement is to emphasize you've got to manage this risk. We at Max Out Savings Advisors, we manage risk for retirement. We have to manage people's retirement assets. It's got to be long-term money, and it's got to perform well. But it also we try to sit there and maintain, because it doesn't do any good if you do super well when the market's going up and then you get blown out and the market goes down and your account's down 30% and people panic, they liquidate everything, and then the markets eventually ultimately go up and stuff, but they're afraid to do anything. So you're better off doing well on the upside, but also managing your risk so you're not backed into a corner where you've got to make some decisions you don't want to because you're a retiree, you're concerned about your future, and you'll have enough money, and you're forced to sell out everything. And that's something that's not well understood by many advisors and money managers. I mean, they're like, hey, long term, this, that. That, number one, most of them have not been through a bad bear market. They don't understand what type of damage it can do to a retirement account and to people's standard of living. It's something. I mean, it's surprising. I saw a statistic that, I think it's 32% of asset managers out there don't have any positions in precious metals. Well, precious metals have outperformed the S&P 500 on numerous annual things over the last 3 or 4 years, some cases longer than that. If you look at, I think gold's up 45% year to date, but these people, they don't understand what's happening in the world. All they know is, hey, you get in the S&P 500 and it goes up every single year, and if it has if it goes down in a bear market, that lasts about a year and a half, and then it's back up to new high. That's not the way the world works. And the world is changing. The Fed, all these people, they're going to be under pressure to sit there and rein in the money printing, which has been bailing people out over the last, really it's been about the last 5 or 6 years. And this is why gold is going up like it is. Now, is gold going to go up another 45% next year? I don't know. That's going to be kind of tough. I think you got to be a little careful in here. But there's other things out there. The question is, at what point does oil and gas bottom? And there's opportunity. I still think there's opportunities in the precious metals, the mining sector in there, because I think a lot of those guys, I think they're managing the company for earnings now. And we talked about one of the big things we've talked about is the oil and gas sector back in, where was it? Oh, maybe 18 or so. Things were going real well, and then they started expanding. They're all buying companies. They're drilling like crazy. We got 10,000 locations in the shale. We're going to be drilling them all out. They're just blowing and going. And then COVID hits. Oil goes down, and so they're producing so much oil. Oil's pouring onto the market. It starts falling. Then the economy slows down with COVID. Oil prices collapsed at one point, negative rates. A number of oil companies went into bankruptcy. Well, what happened is after that, they said, oh, my God, we're never going to let that happen again. We're not going to drill. We're not going to run the company to produce the most oil. We're going to try to make most money. We're going to reduce our debt. Since then, they've had great earnings. And I think you're going to see the same thing with the precious metals things. A couple things. We write about all this in our Max Out Savings Report, which is a free report we send out once a month. If you're on the list, you don't get called, you don't get bothered. The report just goes out. If you ever want to talk to me, you can get my email and email me or call me. But that's otherwise, just go to maxoutsavings.com. If you need help with your retirement, you're retiring or have an old 401k, would like it managed using our value investing approach to the markets, you can request an appointment. Just go to the website, maxoutsavings.com. You can send me an email or just give us a call on the phone, and we'll get back with you, and we'll sit down with you and show you how we manage money. We're here in Houston, Texas, doing it. So if you need some help, go to the website, maxoutsavings.com. That's maxoutsavings.com. At least sign up for the free report. Now, anyway, I hope everyone has a great weekend. And remember our motto in philosophy, which is to save aggressively and invest conservatively. Save aggressively, invest conservatively. That, my friends, is the key to building up wealth over the long term. You have to take charge of your retirement. You have to protect yourself, and you need to be proactive. So remember, save aggressively, invest conservatively. We'll see you next week right here on the Max Out Savings Show.
This has been the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Join us next Saturday at 10 a.m. for the Max Out Savings Show with Ted Gioka on AM 1070. The Answer.